Hi, Matt McAleer, March 5th, just after the close. A lot of volatility this week. Probably hard to believe midweek or even yesterday, even this morning, that we'd finish positive on both the Dow Jones and the S&P for the week. NASDAQ down, call it 2%. What we're seeing so far is the damage is being contained primarily to those high-flying sectors. Electric vehicles, solar energy, alternative energy in general, genomics within the biotech area. Now, what can go right, what can go wrong there? It can remain contained. The selling can churn in there. Would tend to be unusual if it remained contained. And we have seen some of that selling creep over into the NASDAQ, which at its low point earlier today had reached that down 10% from its all-time high. So it's a run-of-the-mill standard correction, especially in the NASDAQ. But in terms of what we're seeing from that crowded trade, a lot of damage. We've spoken about that continuously now and really started harping on it over the last 3 or 4 weeks when we saw these trades within small, tight sectors being funded with money. And what do we talk about? Late money always loses. Late money gets spanked month in, month out, year in, year out. You saw some of these funds double in size, double in AUM, that invest in these sectors from December through March 1st. Very difficult to efficiently invest in tight sectors with that kind of growth. So you're seeing that, remember what we talked about, that small door. When the money comes out the door, that door seems to narrow. And that's what you're seeing. When some of these funds become sellers of their own securities that they've been buying all along, there are not many natural buyers on the other side of that sale. They're forced to get into the more liquid names, and that's where the NASDAQ's been hurt a little bit. You know, in your Amazons, your Microsofts, your Apples. When some of these funds need liquidity, they need to go to the liquid names. The negative is that leaves them with fairly illiquid names in the portfolio. Should be interesting to see how this works its way out. In terms of the broad market, what do we like to do? We like to look at what other asset classes tell us. Gold, down this week. Treasuries, 10 and 30-year, yields up. No bid there. Japanese yen, and I mention the yen from time to time, and I get some emails on that. The yen has historically been a great risk indicator in when it rallies, and especially rallies versus the dollar, there is some risk-off behavior that follows. This week, yen was quiet, was soft versus the dollar. So what we're seeing is many of the indicators we look at that tip us off to trouble in the broad markets aren't tipping their hand yet. You know, look at yield spreads between high yield and treasuries. When there's trouble in the market, when there's real trouble, we see those spreads widen. You need to pay, companies need to pay a higher coupon to collect money. Not so right now. Those spreads stayed narrow even through last night's close. I'll take a look at the spreads after today. So what we're seeing right now in our estimation is some very nasty volatility in some crowded trades. We knew it was coming. You knew it was coming. The way to adjust to that is let the market talk to you. What is the market trying to teach us? It's trying to teach us that banks trade dry. Old energy trades wonderfully. International trades very well. Both emerging markets and developed markets are up this week. Really, the damage is contained to the high-flying sectors and the NASDAQ. We'll throw the NASDAQ in there, down 2% on the week. So very important for us to listen to what the market's telling us. As I say, we try to learn from the market every week, every month, every quarter. Right now, the market's telling us that there are sectors that are working. besides the ones I mentioned, we'll throw in industrials and basic materials. Listen to the market. It will help you on your net return year in and year out. One last quick note. Dr. Leo Chen runs our quant trading business. He received a buy signal in his quant work at the close of business yesterday. If you recall last week when I was on, Leo had received an intraday buy signal. At Cumberland, we use a close day. We like the full options work to be threaded into the algorithm. So Leo received a buy signal. What that means for you as a client is that 10% allocation, that 10% sleeve in our U.S. portfolios is now invested in SPY, in the S&P 500. At the same time, 3 of our defensive sectors, low beta sectors, have been sold. Those were staples, communications, and healthcare, replaced by 3 aggressive or high beta sectors. And those were financials, energy, and technology. So quite a bit of trading here today. You'll see us write a note on this next week. Have a great weekend.
Hi, I'm Patty Healy, Senior Vice President of Research at Cumberland Advisors. I'm filling in for John Mousseau today, and it's March 5th, 2021. Think about last year at this time. The sky was falling. People didn't know what was going to happen. Things were shutting down all around. And municipal bond credit quality took a hit in some cases, in other cases didn't, but people were extremely worried about them as well as others. Only until later in 2020 did downgrades start surpassing upgrades for municipal bonds. But for the 5 years prior to that, municipal credit quality had been going up and up because they had increased their reserves and reduced their debt. So when the pandemic hit, they were in somewhat of an okay position at most municipalities. Additionally, where we had the stimulus that helped businesses and individuals so that they can continue operating or at least spend money. And so we will see what happens going forward. It appears that the rating agencies are being patient in downgrading credits because they understand that this is an extreme situation. So dipping into a reserve fund or issuing bonds to restructure the bonds so that you don't have to pay as much debt service in the early years so that you have some cushion. Those are things that normally a rating agency would downgrade an issuer before because they were having some kind of issue and they weren't addressing it and getting structural balance. So what we'll see going forward is those municipalities that can regain structural balance will probably stay the same, while some others may be downgraded, and we'll keep our eyes on that. So moving to the action in the bond market today, with the vaccine rollout and more people going back to work and some states opening, we've had some good economic numbers, and the bond market flirted with a 1.6% interest rate for the 10-year. Some people may have mentioned that it was a bond tantrum, but here at Cumberland, we think it's a return to normalcy from the extreme recessionary drop that we had from the pandemic. So the 10-year ended this week at 155, up 14 basis points from 141 at the end of last week. And the 30-year bond, which had started the week at a 215, ended the week at a 227, up 12 basis points. Muni yields declined for the week a little bit because the scales had been cut maybe over too much last week. This is the Muni AAA scale that we're talking about. And also supply was really low. So the Muni 10-year ended the week at a 111, down 3 bips from a 114 at the end of last week. And the 30-year bond, the 30-year Muni ended at a 176, down 4 basis points from 181 last week. The Muni Treasury ratio that's been bouncing around quite a bit, and in the 10-year space ended at 71%. The yield of the 10-year bond was 71% of the Treasury bond. And in the 30-year space, it was 77% of the 30-year yield. So it's kind of a little bit more normal. Initial jobless claims were better than expected at 745,000 compared to expectations of 750,000. So it's flat, but at least jobless claims are going in the right direction. What was a big surprise today was the non-farm payrolls number. It was expected to be an increase of 200,000. Meanwhile, we had an increase of 379,000. This got people worried that the economy is going to reheat, and that's why bond yields kind of went up a bit. And there's, people are worried about inflation. So we're looking next week for CPI and PPI. And on the CPI, we're looking for core CPI to increase a couple of basis points, not necessarily because we think inflation is creeping up, but because the decline in the inflation numbers in the core CPI were so severe earlier or last year at this time that they're coming, it's a change up from a lower number. So most of the market seems to know that math. We'll see what happens, and it should be an interesting week. Have a great weekend.